So the buying the dip strategy that has worked so well over the past 10 years is failing miserably during this bear market. So if buying the dip does not work, what does? Hi guys, it's Stock Curry, and as the market continues to drop and the bear market rages on, buying the dip is no longer working. So in today's video, I'm going to give you 4 easy ways to make money as the market goes down. So let's get into it! To make money in this bear market, we first have to understand why the market is dropping. In general, the market is dropping due to a global slowdown and an upcoming global recession, with some countries already in recession and other countries, such as the United States, about to enter a recession. The recession has been fueled by a combination of high inflation and rising interest rates. All asset classes, including stocks, bonds, cryptocurrency, and real estate, are selling off as the Federal Reserve and other central banks around the world raise interest rates in order to battle inflation. And now the Federal Reserve has endorsed the idea of a recession in order to get inflation down. The Federal Reserve is now forecast to raise rates to 4.6% by early next year, indicating they are going to raise rates by 0.75% at their next meeting in November and then 0.5% at their meeting in December. The Fed also forecast that unemployment could rise to 4.4% next year, and Federal Chairman Jerome Powell steadfastly warned that the Fed will do whatever it needs to do to crush inflation, including causing a recession. Julian Emanuel, the head of equity, derivatives, and quantitative strategy at Evercore, said, "By basically endorsing the idea of a recession, Powell set off the emotional phase of the bear market." The bad news is that you are seeing and will continue to see it in the near term in indiscriminate selling of virtually every asset. The good news is that tends to be the end game of virtually every bear market we've ever witnessed, and it's coming in September and October, where that has historically been the normal state of affairs. Now, I've been saying for a long time that the bear market would most likely end in October, and that is based upon history mainly. September is historically the worst month for the stock market, with the last week of September historically being the worst week of the stock market, which we are coming up on this week right here. Now, we already had the worst week last week, so we might trade a little bit flat this week before we continue going down. That said, October is also historically the month where we get the most number of crashes, and that would line up with this emotional stage that we're in the stock market, where at the very end of bear rallies, we often see one final epic sell-off before the bear market finally ends. This epic sell-off drives the VIX, or volatility index, up to 40, which is a technical indicator that technical traders look for to indicate the end of a bear market. In addition to that, October is also historically the end of most bear markets. Since most bear markets end with one final epic crash that usually happens in October, and then October is the end of most bear markets after that final epic crash. So all signs are leading up to and indicating that the bear market is going to end in October. In the short term, though, we could still have quite a bit of pain ahead of us. Now, even though Jerome Powell is endorsing a recession, there's still a lot of uncertainty about just how bad that recession will be. And because there's still uncertainty, that will put a floor on how far the market drops this year. Atlanta Fed President Bostic said we are going to get job losses, but there's a good chance that we can get back down to that 2% inflation rate without completely killing the economy. On the other hand, there are still fears that inflation could rise once again. as shipping trade is moving away from the West Coast ports of Long Beach and Los Angeles due to ongoing concerns about labor strikes, the East Coast is having a trade congestion with vessel wait times piling up, and that could cause inflation to rise once again. Another thing to consider is the fact that so far the stock market has been dropping due to rising interest rates and high inflation. We have not yet seen the stock market sell off due to a decrease in earnings. Even though a lot of companies have reported a decline in earnings and they have lowered their guidance for the next year, stocks have not completely reacted negatively to that yet. And usually we don't get a bottom in the bear market until stocks start selling off due to a decline in earnings. That said, there will definitely be some companies that get hurt more than others. Two companies that could get hurt the most by President Biden's quote-unquote Inflation Reduction Act are Berkshire Hathaway and Amazon. Berkshire Hathaway's taxes are expected to rise by 7%, and Amazon's are expected to rise by 2%. And with Amazon already continuing to report declining earnings, this increased tax could hurt Amazon even more next year. Despite that, Amazon's price to earnings ratio is still well over 100, and keep in mind that a fair price to earnings ratio is around 15. Even Apple is only trading at around 25, making Amazon very expensive from a fundamental standpoint. And that leads me to how we can actually profit as the market goes down. The buying the dip strategy soared in popularity over the past decade as the stock market went on one of the longest bull runs ever. Unfortunately, the buy the dip strategy is now backfiring as share prices continue to plunge. Despite continuing to lose money, investors are having a very difficult time overcoming their habits, and they keep buying the dip anyway. So the buying the dip strategy that has worked so well over the past 10 years is failing miserably during this bear market. So if buying the dip does not work, what does? Well, here are 4 easy ways to make money as the market goes down. The first way that you can make money as the market goes down is by buying and selling put options. Now, this is by far the riskiest way to make money as the market goes down, but I did want to point it out as one easy way to make money. I just showed you how Amazon's price to earnings ratio is far too high and how it needs to come down as their earnings are continuing to drop and their taxes are about to increase. And last week, I made a 65% profit by buying an Amazon put and then selling it 2 days later. Just remember that buying and selling put options is very risky, and I do not recommend you do it unless you have a lot of experience with trading options. So let's talk about some other ways to make money as the market goes down that are significantly less risky. And one of those ways is with inverse ETFs. Inverse ETFs go the inverse or opposite of the market. So if the stock market is going down, an inverse ETF will go up. And there are 2 particular ETFs that come to mind that are 3 times leveraged on the market. One is for the S&P 500 index, and that is called SPXU. And the other one is for the NASDAQ index, and that is called SQQQ. Last week, Stochitsky made a 6% profit trading SQQQ and thanked me for opening up his eyes to a new world of trading. For a lot of people, making money as the market goes down is a new concept. The best part of all is we've only talked about 2 strategies so far, so let's talk about the third one. And the third strategy is by buying something called the VIX, or an ETF that trades the VIX. The VIX is a volatility index that is mostly based upon how many puts are being purchased on the S&P 500. The VIX goes up whenever the market goes down. Now, if your broker does not allow you to trade the VIX directly, you can buy some VIX ETFs. And the two that are most popular are UVXY and VXX. Both of these will go up as the market goes down. Just keep in mind that UVXY and VXX are based upon short-term futures, so they don't 100% follow the VIX. Also, keep in mind that with any of these inverse ETFs, whether we're talking about SQQQ, SPXU, UVXY, VXX, or any others that go up when the market goes down, these are designed to go down in price over time. And that's just due to the very expensive nature of trading short-term futures. So I do not recommend that you hold any of these for longer than about 1 week, or there is a very good chance that you will lose money. These are trading instruments, not long-term holding instruments. Now let's say that you don't like trying to time the market and you're looking for something you can hold a little bit longer than 1 week. If that's you, then the 3 things we've talked about so far probably aren't going to work. And the best strategy for you is the 4th way to make money as the market goes down. And that is quite simply buy the dip. Believe it or not, even though buy the dip has not been working that well for now, with the market continuing to decline, now that all 4 major indexes are in a bear market territory, as we get closer to a bottom in this bear market, which I think is going to happen in October, buying the dip is going to be by far the best strategy. Buying the dip works if you have a long-term time horizon. Over 15 years, every single point in time in history, no matter when you bought, 15 years later, the market is up. Now, I don't know when the market's going to bottom out. I don't know when the market's going to turn around. But what I do know is that if you have a long-term time horizon, then buying the dip is the best strategy. And that is why, if you look at our $1 million challenge portfolio, even though the stock market continues to drop, I continue to dollar cost average in. Because over the long term, buying the dip will make money. And if you're smart about the stocks that you buy and you pick some high quality stocks that are undervalued and oversold, you can make money by buying the dip. Just be careful and try to stay away from the stocks that have not yet fallen enough, and try to stay away from those stocks that remain overvalued. A lot of the large cap tech stocks have not yet fallen to undervalued levels. Apple, Amazon, and Tesla all remain overvalued despite being in a bear market. Your best bet are finding the stocks that have been severely beat down. The categories that come to mind at this immediate moment in time are the small cap growth stocks as well as some dividend stocks. There are quite a few great dividend stocks that are now paying 7 and 8% dividend yields. And in addition to that, there are quite a few high quality growth stocks that have been beat down between 60 and 90% from highs that now have PE ratios that are well below 8. So this is a great time to buy the dip if you're a long-term holder, and if you can just hold on long enough to actually see a profit on those stocks. It takes incredible patience, but if you're patient, it will work. Now, if you're looking for a broker to buy the dip on, or if you just want to trade options and make money as the market goes down, I do recommend Moomoo. Moomoo has a special promotion right now, their best promotion ever, where they're offering up to 15 free stocks when you open an account, but you have to use my link in the description below if you want to get those 15 free stocks. If you enjoyed this video and got a lot out of it, be a good friend and share this video with your friends and family, and make sure you hit the like button and subscribe and click the bell icon and click all so that you don't miss out on my next video. Also, make sure you watch this video that I uploaded here so that you'll know more about why the stock market is falling.